Hey everyone, Hunter Satterfield here, one of the partners at Kane Waters and Associates, as well as the Chief Investment Officer. As always, I am joined by my fellow partner, Brian Bortz, who is the head of our investment committee here at Kane Waters, as well as Brad Sanders, the Managing Director of Tectonic Advisors. This is your January 2026 update. The S&P 500 for the month was up 1.4%. Global stocks were up 3.3%. Domestic bonds up 0.1%, and then global bonds up 0.9%. Now, importantly, some of the things that we talked about on our last recording, we've been talking about on the podcast and other areas, is we are continuing to see this sort of sector rotation that we've been talking about, which I'm going to have Brad talk about here in just a second. But for the month of January, again, the S&P's up 1.4, with global stocks up 3.3. Small cap stocks for just that month were up 5.7. So that is continuing. For January, and we can take this all the way back to November 1st. So now we're on a 3-month run here. Since November 1st, small caps are up 8.4% compared to the S&P of 1.8. So it is continuing, Brad. I want to start with you. Just maybe, again, sort of reiterate not only what has happened, but then why is it persisting and in such a great manner?
Yeah, I think a variety of factors. I think the AI story has hit a pause here, and that narrative has kind of rolled over in real time. And that just means that there's a tremendous amount of capital that needs to get reallocated because that trade was so concentrated. 40% of the S&P in the top 10 stocks, and 7 or 8 of those are AI related. And so if you just re-rate that 10%, that's $1.5 trillion that's got to go somewhere. And if you look around the rest of the market's kind of starved for capital, and it's much cheaper, valuation-wise. Really, any way you want to slice it, it's much cheaper. And so I think as that narrative is getting steam, you started to see not just small caps, if you want to break it out like that, but defensive sectors, healthcare, consumer staples, just all kinds of stuff that's just been meandering around for the last couple of years has all just caught a bid simultaneously. At the same time that you've seen kind of rate cuts stall out, which is going to kind of hurt these big tech companies that are they're financing a lot of this future growth with debt, and they were expecting rates to come down. And after we got a hot PPI last Friday, and the Fed came out last week and said we're on pause. Now we got a new Fed chairman in May. It looks like those debt financing costs are going to be a little bit higher and stickier than they were expecting. So that's going to kind of eat into some of their profitability. So I just think the market's looking around and going, yeah, this stuff's too expensive. The rest of the market is cheap, and we've got kind of the wind at our backs in terms of growth, in terms of what the administration's doing. So why not buy this other stuff? Because those policies are going to benefit everything, not just tech. And so I think that's why this has continued. It's firmly entrenched. We've strongly outperformed again the first 2 trading days of February. Today was a really bad day, and our active equities as a group were green today with the S&P down 90 bips. So it just seems like a trend that's fully kicked in, that we've been talking about for a number of years, and we're pretty excited about it.
Yeah, and I think we saw, again, similarly with international stocks in January. We saw that last year with international ripping 30+% compared to the S&P of 17. So, Brian, I want to come over to you, and you start to see these things in the markets, and then how that sort of widening and broadening of the markets plays into our client portfolios as well. I mean, what can we take from this 3, 4, 5 month story that we see as we go back to our portfolios? What can we take sort of as an education?
Sure. Yeah, it's interesting. Just to play off of what Brad said for a second about how all the big companies at the top. Brad, do you know the newest, sexiest $1 trillion company in the market?
I know. Walmart today.
Correct.
Yeah.
Walmart. So that thing that speaks to what Brad was saying earlier is that there is a widening and a broadening of the market, and that's precisely why we have our portfolios diversified. So we talked for a long time about why it doesn't necessarily make sense to be over concentrated in just a handful of stocks, because stocks move quickly and they move over time as well, and they move differently. And so from our clients' perspective, having exposure to small cap since November has really added to a lot of your financial plans. It didn't always look like that was something that you wanted to have exposure to whenever only 7 stocks were ripping. But now it makes sense. And so from our perspective, when you look at how we diversify our portfolios, not only are we diversified by market cap, large or small, We're diversified by whether or not it's a dividend-paying stock or a growth stock. We're diversified by whether it's a global stock or a domestic stock. And so whether it's stocks or bonds, what type of bonds? Brad had a wonderful recording last week that if you haven't listened to yet, you need to, on why it's important to have actively traded bonds. And so there's a lot of things that we do intentionally with our goal of trying to have that done before there's a problem, so that we can take advantage of things that have happened just like since November.
That's right. And it's an interesting year, obviously. We're just 1 month in so far. But we've got, obviously, midterm elections this year. We've got a brand new Fed chair. We continue to have the AI story, especially when you start looking at, hard metals, hard assets that are needed for that. So all kinds of interesting stuff going on in the markets. So as always, we'll be back in front of you at the end of February. Thank you so much.